Hello, this is Professor Marsh, and this is the homework video for Chapter 11, Unit 11 in Accounting 432 at Newberry College, fall of 2022. So let's get right to it. So the first homework problem we had is problem number 2. This is the Potomac Corporation that wants to sell a warehouse that it has used in its business for 10 years, and Potomac is asking $450,000 for the property. The warehouse is subject to a mortgage of $125,000. If Potomac accepts Wyden Incorporation's offer to give Potomac $325,000 in cash and assume full responsibility for the mortgage on the property, what amount does Potomac realize on the sale? So we're looking at the amount realized on the sale, and that includes both the cash consideration of $325,000, but also the mortgage assumption and debt relief of $125,000. So that's a total of $450,000 as the amount realized by Potomac. Let's go on to the next one. That's number 3. So this is Montana Max sells a 2,500-acre ranch for $1 million in cash, a note receivable of $1 million, and debt relief of $2,400,000. He also pays selling commissions of $60,000. In addition, Max agrees to build a new barn on the property. The cost is $250,000 and spend $100,000 upgrading the fence on the property before the sale. What is Max's amount realized on the sale? Well, the amount realized includes the cash of $1 million, the note of $1 million, and the $2.4 million of mortgage assumption. That's $4.4 million in total consideration, minus the commissions of $60,000. So the amount realized by Montana Max is $4,340,000. Note that the $250,000 barn and the $100,000 fence improvements, those would be added to the adjusted basis, and so those would reduce the amount of gain realized by Max on the sale. Let's go on to number 7. Number 7 says explain the difference in or between ordinary capital and Section 1231 assets. And so what I'd like to do to explain that is to go back in your chapter 11 to pages 7 and 8 where they have that explained as well. So ordinary assets are generally assets created or used in a taxpayer's trade or business. They give you an example of that as inventory is an ordinary asset because it's held for sale to customers in the ordinary course of business. Accounts receivable are ordinary assets because they represent what's generated from the sale of inventory or business services. And other assets used in a trade or business, such as machinery and equipment, are considered to be ordinary assets if they have been used in the business for 1 year or less. And they give you an example of a forklift. Now, a capital asset is generally something that's held for investment, for the production of income, and whether an asset qualifies as a capital asset depends on the purpose for which the taxpayer uses the asset. So the same asset may be considered a capital asset to one taxpayer and an ordinary asset to another taxpayer. For example, a piece of land held as an investment because it's expected to appreciate in value over time is a capital asset to that taxpayer. However, the same piece of land held as inventory by a real estate developer would be an ordinary asset. Finally, the same piece of land would be a 1231 asset if the taxpayer held it for more than 1 year and used it in a trade or business, such as a parking lot. So that's a pretty good example that's right there on page 11-8 in your book. Now, 1231 assets are depreciable assets on land used in a trade or business, including rental property, held by taxpayers for more than 1 year. 1231 gains on individual depreciable assets may be recharacterized as ordinary income under the depreciation recapture rules. And note the footnote that's down at the bottom of page 11-8 that is that section 1221 of the Internal Revenue Code defines what is not a capital asset. Broadly speaking, a capital asset is any property other than property used in a trade or business. For example, inventory, manufacturing equipment, or accounts or notes receivable acquired in a business from the sale of services or property. So Section 1221 defines what is a capital asset by exception, defining it as those assets which are not ordinary income assets. Let's go on to number 8. And for number 8, we're going to take a look at, well, let's go ahead and ask the question. Discuss the reasons why individuals might prefer capital gains over ordinary gains. Explain why corporate taxpayers might prefer capital gains over ordinary gains. Okay, well, there's an exhibit that discusses that on page 11-9 of your chapter. And so it gives some detail on the preferential rates that are available to individuals on the sale of capital assets, and also the loss limitations that apply if you have a loss on the sale of capital assets. And then it also has a discussion of C corporations as well. And so for individuals might prefer the sale of capital assets because of the preferential rates. That's usually the case. And corporations might have a capital loss carry forward to use. And so they might prefer capital gain in those situations, because otherwise they can't use the capital loss unless they have a capital gain to offset it. So, and the capital losses for corporations can be carried back for 3 years and then carried forward for up to 5 years. Let's move along. The next question is chapter 14. Question number 14. This is for learning objective number 3. What are the similarities and differences between the tax benefit rule and depreciation recapture? Remember the tax benefit rule from the income chapter and the example of state income taxes. If you took a deduction as an itemized deduction for state income taxes, but you later got a refund of some of those state income taxes, if you had gotten a benefit from the state income taxes, you would have to pick up the refund as income on the year in the year that you received that refund. Now take a look at page 11-10 and the definition and types of property and recapture, and you can see that in the both in the discussion of depreciation recapture. Depreciation deductions save taxes at the ordinary rate, but the gains created by depreciation generate income tax at preferential rates. And so this potentially asymmetrical treatment led Congress to implement the concept of depreciation recapture. And so depreciation recapture potentially applies to gains but not losses on the sale of depreciable or amortizable business property that had previously benefited from depreciation deductions, and it reclassifies what otherwise would be capital gain as ordinary gain. And you can see on page 10-11 the definition and types of that, and then also see the 3 scenarios on pages 11 through 13 with the examples 11-6 through 11-8 in your book of those how that recapture can be taxed. So let's go on to number 18 in your chapter. Question 18 says Bingham Resources sold 2 depreciable Section 1231 assets during the year. One asset resulted in a large gain. The asset was sold for more than it was purchased, and the other resulted in a small loss. Describe the Section 1231 netting process for Bingham, and I'm going to refer you to Exhibit 11-8 on page 11-20. And if you go back to that particular page, what you'll see is, and I'm going to get back to it right now, and I will show it to you. You can see the Section 1231 netting process in your book, and it describes how that works. So if you have a Section 1231 gain, you first have to apply depreciation recapture and subtract that, and then the net remaining Section 1231 gain with Section 1231 losses, those are netted, and if there's a net Section 1231 loss, then that becomes an ordinary loss. And if you have a net Section 1231 gain, you have to first apply the look-back rule, but if not, if there's no losses that are accumulated in the past, then you have long-term capital gain if you haven't had any Section 1231 losses in the past 5 years. So that's the rule on that. Okay, let's go on to question number 24. Question number 24 is, let's see where that is. Why does the tax code allow taxpayers to defer gains on like-kind exchanges? Well, let me just say that having spent my career doing like-kind exchanges, I'm personally offended by that question. Why would they allow taxpayers to defer gain on like-kind exchanges? Because that's what's supposed to happen. How do the tax laws ensure that the gains or losses are deferred and not permanently excluded from taxpayer income? Now, that's a legitimate question, but if you will go back in your book to page 11-24, you'll see the answer to both of those questions. And what you will find on page 11-24, and I'm stalling for time as I'm trying to get through to that page, there's a discussion in the middle of the page that says taxpayers exchanging property for property are in a different situation than taxpayers selling the same property for cash. Taxpayers exchanging one piece of business property or investment property for another haven't changed their relative economic positions because both before and after the exchange they hold similar assets for use in their business. Further, exchanges of property do not generate the wherewithal, the cash, for the taxpayers to pay the taxes on the gain they realize and recognize on the exchanges. In other words, it's both based on an ability to pay, but also a failure of the taxpayer to cash out and to, even though they realize the income, they shouldn't have to recognize the income because their economic condition really hasn't changed. So that's why we allow taxpayers to defer the gain. And then if you look at example 11-15, you'll see what happens on a Section 1031 exchange is that the amount of the deferred gain reduces the basis in the replacement property. And so that basis adjustment causes the taxpayer to carry forward a lower basis, and then if they sell that replacement property, then the gain is realized and recognized at that time. However, if the taxpayer does a like-kind exchange and holds the property until they die, then the recipient of the property at death, the person who inherits that property or otherwise receives it upon the death of the taxpayer, gets a step up in basis without the payment of tax, and the tax is avoided and effectively excluded. So the book does not emphasize that but I am emphasizing that for you right now to talk about why Section 1031 exchanges are such a great idea, particularly for people who invest in real estate. Okay, the next question is question number 25. Describe the like-kind property requirements for real property for purposes of qualifying for a like-kind exchange. Explain whether land held for investment by a corporation will qualify as like-kind property with land held by an individual for personal use. Well, okay, first of all investment or business real property is considered to be like-kind for all other investment or business real property, and that's true whether it's for individuals or for corporations. Now, land held for investment by a corporation is not like-kind for property held by an individual for personal use, unless when that property is exchanged and the corporation receives it, they change the use of that property from personal use to investment or business use. So personal use property, such as your personal residence, a vacation home that's not used for investment or business, that property cannot be exchanged under Section 1031 like kind. But the property that is held for rental, held for appreciation, held for investment, held for use in a trade or business, that real property, anything that is real, is considered to be real property under the applicable state laws, are treated as like kind for any other real property used for that qualifying purpose. So that's how those rules work. Now, let's go on to number 37. Minuteman wants to enter into a like-kind exchange by exchanging its old New England manufacturing facility for a ranch in Wyoming. Minuteman is using a third-party intermediary to facilitate the exchange. The purchaser of the manufacturing facility wants to complete the transaction immediately, but for various reasons, the ranch transaction will not be completed for 3 or 4 months. Will this delay cause a problem for Minuteman's desire to accomplish this through a like-kind exchange? Explain. Well, under Section 1031, you can have a simultaneous exchange in which both the relinquished property is transferred out and the replacement property is transferred into you at the same time, but you can also have a deferred exchange. And under the deferred exchange rules, you merely have to receive the replacement property. We have to identify the replacement property within 45 days of the transfer of the relinquished property. In this case, Minuteman knows what their replacement property is. They just can't get the replacement property for 3 to 4 months, but you have 180 days to receive the replacement property. And so if you're doing this through a qualified intermediary and facilitating the exchange, you can certainly do this and still have a good Section 1031 exchange. And so that's the answer to that question. Now let's go to Olympia Corporation of Kittery, Maine. Now, I've been to Kittery, Maine several times. If you ever go to Kittery, Maine, I would recommend that if you have not been to a real Maine lobster pound, that you consider going to the Chauncey Creek Lobster Pound in Kittery, Maine. You will get a great lobster. You will have the full Maine lobster experience. It's not fancy, but it's certainly delicious, and it may be a little touristy, but Kittery is a beautiful little waterfront town right when you get into Maine across the border with New Hampshire, and I do highly recommend it. Well, Olympia Corporation wants to exchange its manufacturing facility for Bangor Company's warehouse. Both parties agree that Olympia's building is worth $100,000 and that Bangor's building is worth $95,000. Olympia would like to do the transaction to qualify as a like-kind exchange. What could the parties do to equalize the value exchange but still allow the exchange to qualify as a like-kind exchange? What would the necessary change affect the tax consequences of the transaction? Well, Olympia's building is worth $100,000. Bangor's building is only worth $95,000. Typically, what would happen is that Olympia would transfer its building to Bangor, and Bangor would transfer their $95,000 building plus $5,000 in cash to equalize the exchange. And what would happen is Olympia would recognize $5,000 in gain because of the receipt of $5,000 in boot. Now, what Olympia could do is Olympia could set up an exchange through a qualified intermediary, and Bangor could pay that $5,000 boot into the intermediary, and then Olympia could designate $5,000 of other real property that it wanted to acquire, and perhaps more than 5,000, but at least to use that 5,000 toward the acquisition of the second property, and then would have a good like-kind exchange without the receipt of boot. But if Olympia does get the $5,000 cash and boot or some other consideration besides qualifying real property for the exchange, then it's going to have to recognize at least $5,000. If its gain is at least $5,000, then it would have to recognize $5,000 of that gain on the exchange. Okay, Raphael. This is number 32. Raphael sold an asset to Jamal. What is Raphael's amount realized on the sale of in each of the following alternative scenarios? So Raphael received $80,000 in cash and a vehicle worth $10,000. Raphael also paid $5,000 in selling expenses. Okay, so in this question A, Raphael has received $80,000 in cash, a $10,000 vehicle. That's $90,000 minus $5,000 in selling expenses. So Raphael's amount realized is $85,000. In Part B, Raphael receives $80,000 in cash and was relieved of a $30,000 mortgage on the sale he sold to Jamal. He also paid a commission of $5,000 on the transaction. Okay, so the mortgage relief is treated as consideration to Raphael. So he's got $80,000 in cash plus the $30,000 mortgage relief. That's $110,000 minus the $5,000 commission, and so his amount realized is $105,000. The $110,000 minus $5,000 equals $105,000. In C, Raphael received $20,000 in cash, a parcel of land worth $50,000 and marketable securities of $10,000. He also paid a commission of $8,000 on the transaction. So in this case, he's got $20,000 in cash, a parcel of land worth $50,000. We're not told what type of asset he sold, but I'm assuming that the parcel of land is not like-kind with the asset that was sold, and then a marketable securities of $10,000. So we've got $80,000 in total consideration, minus $8,000 for the commission, and so the amount realized is $72,000. Okay, number 33. Alan Muir inherits a hotel from his grandmother Mary on February 11th of the current year. Mary bought the hotel for $730,000 3 years ago. Mary deducted $27,000 of cost recovery on the hotel before her death. The fair market value of the hotel in February is $750,000. Assume the alternative valuation date is not used. We haven't talked about alternative valuation date, but if that is the date that's used to report Mary's federal estate tax return, Form 706, then that becomes the basis and not the date of death value. The alternative valuation date is 6 months after the date of death of a decedent, and that alternative valuation date is there in the tax code in case the market is unstable during the administration of the estate. If there's a great increase or decrease in the value of assets during that time, the people administering the estate might be able to achieve some sort of a tax benefit by using the alternate valuation date. So what is the first question? A, what is Alan's adjusted basis in the hotel? Well, that question is relatively easy. Under Section 1014, he receives a basis based on the fair market value as of the date of death, and that's $725,000 under Section 1014 of the Internal Revenue Code. Question B, if the fair market value of the hotel at the time of Mary's death was $500,000, what is Alan's basis? At that point, he receives a basis of $500,000 based on the value at the time of her death, also under Section 1014 of the tax code. Let's move on to question number 37. Question 37, on December 30th of last year, Rex received some investment land from Holly as a gift. Okay, so now we have a gift not at death, but we have a gift during lifetime. Holly's basis was $50,000 and the land was valued at $40,000 at the time of the gift. Holly acquired the land 5 years ago. What are the amount and character of Rex's recognized gain or loss if he sells the land on May 12th of this year in the following prices? A, $32,000. Okay, so in this case, this is the case where you have the dual basis rules. See page 11-3. And so Rex has an $8,000 loss, and that's short-term capital loss. So the property has depreciated even below the value at the time of the gift. But Rex has to use the lower value, $40,000 as his basis. And then when he sells it for $32,000, he has an $8,000 loss based on the difference between $40,000 and $32,000. And since we're using the loss basis under the dual basis rules, his holding period is deemed to begin as of the time of the gift, not including Holly's holding period, and so it's a short-term capital loss for Rex. Okay, question B, if it's $70,000, then Rex has a $20,000 gain, and it's long-term capital gain under the dual basis rules. If Rex receives a price that's higher than Holly's basis, then he gets to use Holly's basis, the carryover basis, and also Holly's holding period, which was 5 years, remember. So he's got a gain of $70,000 minus $50,000 equals $20,000, and he's got a holding period of 5 years plus the time between September 30th of last year and May 12th of this year. So 5.5, maybe 3/4 of a year as his holding period. Now, if Rex sells it in between the two bases under the dual basis rules for $45,000, this is part C of the question, then he's deemed to have sold it at the basis that is his selling price. And so it generates no gain or loss. The basis equals the sales price when this property is sold, when the price is between the donor's basis and the lower fair market value at the time of the gift. Let's go on to number 40. Okay, so question 40, this is learning objectives 3 and 4. We have Canon that purchased a machine to use in its business for $56,000. In year 3, Canon sold the machine for $42,000. Between the date of purchase and the date of the sale, Canon depreciated the machine by $32,000. Now this is the depreciation recapture rules, and we skipped that when we discussed it in class. And what I said is we're going to learn it by using the material in the homework assignment. So Canon's machine, there's a $56,000 purchase price in year 0, and then over years 1 through 3, they took $32,000 in depreciation deductions, and that leaves them with an adjusted basis of $24,000. So 56 minus 32 is 24. That $24,000 is the adjusted basis. And then in year 3, they sold it for $42,000, and they have an adjusted basis of $24,000. So there's $18,000 in realized gain. Now, what type of gain is that? Well, this is depreciable property used in a trade or business. So our initial analysis says that it's Section 1231 gain, but there's also Section 1245 recapture because there was $32,000 in depreciation deductions, and that's greater than the amount of the realized gain. And so all of the gain is Section 1245 recapture, and it'll be treated as the equivalent of ordinary income. If you have a question about this, go back and look at example 11-6 in your chapter, and that'll be that'll have the same result. So, question B then: what if the amount of the what's the amount and character of the gain Canon will recognize on the sale, assuming that it's a corporation? Well, there are different rules for Section 1250 recapture for corporations. Some of it can be recharacterized as Section 291 gain, but this is Section 1245 recapture, and so I think that it's the same rule for corporations. I think they're going to have the same character of the gain as if they were a partnership. C, what are the amount and character of the gain or loss Canon will recognize on the sale, assuming that it's a corporation and the sale proceeds were increased to $60,000. Well, if it's a $60,000 sales price, then there's $36,000 of realized gain, right? $60,000 sales price minus a $24,000 basis is $36,000 in realized gain, of which $32,000, the full amount of the depreciation taken in years 1 through 3, is going to be Section 1245 gain, and the excess $4,000 is Section 1231 gain that'll be treated as capital gain. Okay, part D of this problem: what are the amount and character of the gain or loss Canon will recognize on the sale, assuming that it's a corporation, the sales proceeds were decreased to $20,000. Well, if the sales proceeds are decreased to $20,000, then if with that section, the $20,000 sales price and a $24,000 basis, there's $4,000 of Section 1231 loss, and that'll be treated as ordinary. There won't be any depreciation recapture in that case, where the property has depreciated more in real value than the amount of the depreciation deductions that were taken. Okay, let's go on to question number 51. This is the Born Guitars question. A corporation, it reported $157,000 net Section 1231 gain for year 6. Question part A: assuming Born reported $50,000 of non-recaptured net Section 1231 losses during years 1 through 3, what amount of Born's net Section 1231 gain for year 6 is treated as ordinary income? So this is the Section 1231 look-back recapture rule, and you can see this discussed in example 11-13 on page 11-19 in your chapter. And what's going to happen is that $50,000 of the gain is going to be recharacterized as ordinary income to offset the non-recaptured net Section 1231 losses during the previous 5 years. Looking at the first year first, and the second year second, the third year third, the fourth year fourth, and the fifth year fifth, it will eat through all 50,000 of those non-recaptured net Section 1231 losses, and so $107,000 of the gain will be treated as capital gain, and $50,000 will be treated as ordinary. Now, in Part B, assuming Born's non-recaptured net Section 1231 losses from years 1 through 5 were $200,000, then what amount of Born's net Section 1231 gain for year 6 is treated as ordinary income? And the answer is all of it. So all $157,000 would be treated as ordinary income, and there would still be, assuming that not all of that $200,000 was incurred in year 1, at least some of that, maybe as much as $43,000, would be carried forward to the next year as non-recaptured net 31 losses, net Section 1231 losses. And that's the answer to that. Now, number 60 is your next question, and this is Metro Corporation, which traded Building A for Building B. Metro originally purchased Building A for $50,000, and Building A's adjusted basis was $25,000 at the time of the exchange. Well, what does that mean? Well, that means that Metro had taken $25,000 in depreciation deductions by the time of the exchange. What is Metro's realized gain or loss following recognized gain or loss and adjusted basis in Building B in each of the following alternative scenarios? Okay, so A, the fair market value of Building A and of Building B is $40,000 at the time of the exchange, and the exchange does not qualify as a like-kind exchange. So we have a realized gain of $15,000, and the $15,000 is going to also be recognized, and the basis of Building B will be $40,000 in the for Metro after the exchange, and the recognized gain of $15,000 is going to be Section 1250 recapture because the amount of the depreciation deductions, $25,000, are less than the total amount of the gain, which is only $15,000. So it'll all be recaptured and treated as ordinary income. B, the fair market value of Building A and Building B is $40,000, and the exchange qualifies as a like-kind exchange. In that case, Metro will realize the $15,000 of gain, but they will not recognize any of the gain because they've acquired like-kind assets in the same amount as the property that they relinquished. There's no boot, and so Metro will not recognize any gain. They'll have a tacked holding period, and their beginning basis in Building B will be $25,000 because it'll be the $40,000 value less the deferred gain of $15,000. C, the fair market value of Building A is $35,000. Building B is valued at $40,000. Metro exchanges Building A plus $5,000 in cash for Building B. Building A and Building B are like-kind property. Well, in this case, Metro has a realized gain of $10,000 and no recognition of gain because of the like-kind exchange, and they also have paid $5,000 in boot. And so what's going to happen is that they have a basis of $25,000 plus the $5,000 that they have paid in boot, so that their basis in Building B will be the $25,000 plus the $5,000, or $30,000 is their basis. Fair market value Building A is $45,000. Metro trades Building A for Building B valued at $40,000 and $5,000 cash. Building A and Building B are like-kind property. Well, in this case, Metro has a realized gain of $20,000, $45,000 minus the $25,000 basis, and they have a recognized gain of $5,000 because they received the $5,000 cash boot. And so that $5,000 cash boot, that gain that is recognized, is going to add to their $25,000 basis and give them a $30,000 basis in Building B. That's the answer to question 60. Okay, let's go on to question 63. This is Russell Corporation's sold a parcel of land valued at $400,000. Its basis in the land was $275,000. For the land, Russell received $50,000 in cash in year 0, and a note providing that Russell will receive $175,000 in year 1 and $175,000 in year 2 from the buyer. Okay, so this is an installment sale. In an installment sale, what you have to do is you have to calculate the gross profit percentage. And so what is Russell's realized gain on the transaction? Well, what happened is they sold a property. parcel of land valued at $400,000. The basis was $275,000, and they received $50,000 in cash in year 0 and a note for 2 following years. So their realized gain, $400,000 minus $275,000. They have a realized gain of $125,000. Okay, so that's their realized gain. The recognized gain in year 0, that's when they got the $50,000. Okay, what you have to do is you have to calculate $125,000 profit over $400,000 and then multiply it by the principal payments received. So $125,000, let's say that's 5 times 25,000, and 400,000 is 4 times 20. Is it 20 times 25? Let's see if we can figure this out. So we got that's 125 over 400 divided by 25. That's 5. Divide this by 25, and you got 16, 5/16. So 5/16 is your gross profit percentage. 1/16 is 8.3%, 8.333%. So you've got let's see, 8.333 times 5. You got 16th. I'm going to have to figure it out here on the computer, so let's get on the calculator. We got 5 divided by 16. Okay, that's 31.25%. So 31.25% times the $50,000 payment in year 1 is $15,625. And then for year 2 and year 3, you have 0.3125 times 175,000, and that's $54,687.50 in realized gain and recognized gain in the next 2 years under the installment sale rules. Plus if there's any interest element, that would be treated as ordinary income as interest. So that's your recognized and realized gain under the installment sale rules. And I hope you enjoyed the discussion today. Very important homework for Chapter 11, one of the most important chapters in the whole book. Have a great day, and we'll talk with you soon. Thanks a lot. Bye-bye.